Today we're going to talk about what does real estate do during inflationary and stagflationary times, and how does it affect your portfolio if you're a real estate investor. So what is stagflation? There are three major economic components necessary for stagflation to occur. And how do we know this? Because it occurred in 1970 and 1980. So what are the three major components that make up stagflation for it to occur? The first one is rising inflation. And I know a lot of you understand what's happening right now. We know that at least what's being reported is somewhere between 7 and 8%. The second one is rising unemployment. And this is a tricky one because some of you are going to say employment is rising, unemployment is declining. Well, more on that later. The third is the declining demand for goods and services, and we're starting to see this, especially during the pandemic and after, and now with rising interest rates, we're starting to see it again. So now let's rip the Band-Aid off on the first one, rising inflation. We all know inflation's going up. Everything's going up. Food's going up. Oil and gas is going up. Rent's going up. Housing's going up. And interest rates are going up. Everything's going up, so price increases are here for sure. And I don't see any ending in sight, especially with all these supply shock issues that we have coming at us right now. And this does not include anything that has to do with the war at the moment, except for the economic sanctions. Go back and look at the video that I did on unemployment, and you will see that we're actually in pretty bad shape. We're actually close to 8%. Now, how do I get to 8% when the media is saying it's 4? U3 is what the media is reporting, and U6 is the real unemployment, because U6 actually includes all the discouraged workers, all the workers that haven't been able to find jobs for some time. So whenever you're looking at unemployment, you have to be looking at U6. 3, demand for goods and services are going down. There's a couple reasons for this. One is prices are going up, so people can afford less. Secondly, supply chain issues are causing inventory to be lower, and I don't see any relief on this in the near future. As I like to say, smart money goes where it's treated well, and if people are going to pay for things, they're going to think about it before they pay too much. So we know that stagflation is declining economic growth or lower GDP. Secondly, high inflation and high unemployment or unemployment increases, as we are seeing in this Great Resignation. But a couple other things that are not talked about a lot. One is supply shocks, which we all know we're having, and the other is monetary policies. We're not going to get too deep into this, but basically what they're talking about is money printing. And of course, we need to print money right now to take care of the things like social services and the pandemic losses, but this does create inflation, which would create stagflation. So for those of you who think I'm crazy, maybe you're just not paying attention to the multiple articles that are all over the internet, from the Washington Post, the New York Times, Barron's, Forbes. The first one, the threat of stagflation is haunting investors. And if you guys are investing, you know what I'm saying. Second one, what is stagflation? Fears are rising that the U.S. economy is headed toward a 1970s-style death spiral. We're going to talk about this in a minute. I'm going to show you, as I said I would, about how stagflation will impact real estate. Another one is the Washington Post. The Fed is charting a course to stagflation and recession, which we already know. And here's one from Forbes. Most Wall Street experts now predict stagflation. Here's what it means for the investors and the U.S. economy. So guys, this is all within the last month. You need to be paying attention to this. But first, let's take a look at the Fed's choices, because they don't have very many. So obviously, the Fed should hike interest rates immediately, cut stagflation risks, says this particular economist. And of course, they did, which slowed down consumption, which made it worse. The second thing that happened when the Fed increased interest rates to help stagflation is that the housing market has now hit a wall. And if you haven't been paying attention, you need to. The point is, the Fed's choices here, guys, are limited. They have to increase interest rates or slow the economy down, which hurts stagflation even more because one of the big components of it is consumption. So now let's take a look what real estate did in 1970s during stagflation. So as you can see here, here's how much the housing prices have skyrocketed over the last 50 years. And I stopped at 2000. The second chart is median sale prices of houses sold in the United States from 1970 all the way to about 2020. I left the pandemic out because that's just an aberration. What I really want you to pay attention to are these two things. Take a look at 1970. As you can see, the average price of a home at the beginning of 1970 was $11,700, and guess what rent was? $108. That was the price of rent in the beginning of 1970. Now let's jump to 1980. This is during and after the period of stagflation. Housing prices jumped from $47,200, and the average price of rent went to $243. So $108 to $243, and $17,000 to $47,200. Now, why is this important? If you take a look at this period of time, housing generally doubled about every 10 years. But during the period from 1970 to 1980, you could see it almost tripled. So it accelerated at a faster rate because the component prices of real estate itself went up a lot during this period of time. And therefore, so did the price of houses. What's most interesting from this chart down here is that you can see from this period to about this period, it doesn't look like much compared to the rest, but you can see it was pretty flat prior to 1970. The other interesting thing that happened during this period of time, Nixon also took the dollar off of the gold standard, which means at this time the dollar started floating freely, which is called a fiat currency, which means that the Federal Reserve can print for things that they need during this period of time. Some would say that during this period of time, prices have gone up on assets largely because we printed money along the way to take care of the economy. So lastly, I want to show you guys what I would be doing if I were you as we head into these inflationary and stagflation times. Now, I went back to 1970 and said, what would I do if it was 1970 and what asset classes did really well? No surprise that there was a bunch of stuff around stocks because the internet is riddled with stuff around the stock market. But I did find some very good stuff. The best areas to invest are in periods of inflation, including technology and consumer goods. Precious metals such as gold, silver have traditionally been viewed as good hedges against inflation. Okay, we talk a lot about this. Obviously, real estate, land and property, fixed rate debt, like commodities, tend to rise in value during periods of inflation or in stagflation. So then I went back and took a look at the asset classes. So equities, treasuries, US T-bills, commodities, golds, and REITs, or real estate investment trusts. How did they do? These were inflation adjusted since 1973, and this was from Schroders Gold. As you can see, gold was clearly the winner here during stagflation during this period of time at higher than 22% as measured by all these other things, not including real estate in this chart. Of course, I love real estate. I'm heavy in real estate, and if you're a debtor, you're going to do very well if you have fixed rate debt heading into these headwinds. They are coming, guys. I give you enough information. Please take action. We want you to come out of this better than when you started. So again, thank you for watching. Be sure to hit like, subscribe, and hit the notification bell if you like these. I love putting these together just for you guys. I'll talk to you soon.